The gentleman from Arkansas, the vice chair of the full committee, Mr. Hill, is recognized for 5 minutes.
Thank you, Chairman. I want to welcome you, Chairman Powell, to the committee. We're glad to have you back and your expertise. And I want to pick up where Chairman McHenry left off on his conversation about Basel III Endgame. You made a good point saying you're not taking the whole concept of reproposal off the table as you review the analytics. And you all discuss the interactivity of that rule with other rules. So if you were to repropose the Basel III Endgame, would the Federal Reserve delay then the long-term debt proposal that's on the table? In other words, would you agree that the agency should not finalize this long-term debt proposal for bank holding companies until banks have a better understanding of what their capital obligations under Basel III Endgame might be?
So we haven't made the first decision yet, so it's hard, I couldn't say definitively. But yeah, that's a question we'd be asking ourselves: is what would be the implication for other rules, including the long-term debt?
Well, and is the Fed considering changes to the requirement for regional banks to issue long-term debt? Right now, it's stated to be issued at 6% of risk-weighted assets, in abundance of caution in case there needs to be a resolution. Obviously, we know the logic for it. But as I understand it, it's being required at both the holding company level and down at the bank level, and that seems redundant to me. Are you aware of that, and have you considered changing that in your discussions?
Yeah, so that's another area where the comment period ended a little while back, and so once again, we're in the process of evaluating the comments. There will be a thoughtful, deliberative process around that. We welcome comments on these kinds of things. They're very important implications for the banks that are affected. We want to understand the effects, make sure we understand them correctly so that we can evaluate, what a final rule should look like.
Good. Let me turn to the monetary policy outlook. As the chairman noted, consumer prices are 17% higher for American households since President Biden was inaugurated back in January of 21. And yet, in spite of that 17% increase in cost, real wages have actually fallen 2% over that period. So there's no doubt that inflation is the biggest issue facing American households, and in my view, there's three principal causes. Certainly, we had supply disruptions, but we've had unprecedented fiscal policy laxity. You described it in a recent interview as unsustainable. But we also think that the Federal Reserve, in my view, and many people on this committee commented, should have reduced accommodation after the pandemic sooner. One of the things coincident with that, which is what I want to talk to you about, is that the FOMC announced in August of 2020 this flexible average inflation targeting framework right in the middle of the pandemic, which many of us didn't understand why the Fed would take that decision then, but it would give you flexibility on the 2%, saying the Fed could allow inflation to rise above 2% and stay there above that level for some time because the Fed had had such challenges in getting the price level to 2%. That was a major shift in the Fed's approach. Do you think, in retrospect of now what we've witnessed over the past 4 years, that that was a mistake in hindsight to change that framework, and is it under review?
So we said we would do a review on a 5-year basis, and that means we'll be starting that review toward the end of this year. So we really haven't started. I do think that the question you raised will be one of the questions we look at. But the bigger question really is that change in the approach was really based on the fact that we'd had very low interest rates and very low inflation for a long period of time. And policy was always very close to the effective lower bound, so there wasn't any firepower for central banks. And so it was a way to keep inflation expectations anchored at 2% and not have them slide down. Now we have entered a different period. The pandemic really may have changed that in a sustained way. We don't know that yet, but that's the big question we'll be asking ourselves is the effective lower bound to be thought of in a different way now? And if it were, that would have ramifications for our framework. But we haven't begun the review yet. It'll begin at the end of this year and probably end late the next year.